You're listening to the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.
Welcome to Volatility Views, the premier program for volatility traders. Each week, we'll take a deep dive into the world of volatility with in-depth analysis, trading activity reviews, strategy breakdowns, cutting-edge education, and much more. We'll also bring you exclusive conversations with the traders, researchers, and asset managers who are reshaping the volatility landscape. If it involves volatility, then you'll find it on Volatility Views. Volatility Views is brought to you by Cboe. Cboe is one of the world's largest exchange holding companies, and we're inspired every day to innovate some of the industry's most powerful products, technology, and solutions. We're the industry's leading force driving access to global markets, a better trading experience, and powerful data and analytics to inform better strategies. We're committed to engineering new ways to help our customers realize their potential and navigate the marketplace of tomorrow, today. Visit Cboe.com. That's CBOE.com to learn more about our expanded offerings. And now, it's time to take a deep dive into the world of volatility. It's time for Volatility Views.
All right, everybody. That music means it's time for Volatility Views, the premier program for volatility traders. What a week. We've been waiting for this show this week, and so much tumult going on to kick off the show. But we're at you, better late than never. My name is Mark Longo from theoptionsinsider.com, as well as, of course, from the ever-exciting Options Insider Radio Network. You guys can always get us live, usually right around noon Central, 1 p.m. Eastern. A few minutes late today, but usually right around that time for this show every Friday. So join us live then if you can make it. If you're surviving this crazy snowtopia, snow blizzard, snowpocalypse here in and around the Chicago area and other areas, and hopefully you're hunkered down. Perfect day to listen to some volatility viewing, and of course, however you listen, live after the fact via our app, by our website, by iTunes, however you get it. Make sure you hit us up with those questions, those comments, those insights, those pearls of wisdom. We do like to hear from you guys. And who doesn't have a question about volatility this week? I think everybody does. So let's get to it. And joining me to do just that, what a round robin of madness it has been, just having everybody on the show today, and with connections and weather and craziness in the market. It's made it hard for people to join, but we got it. We got it nailed down, I think. Let's start off first. Both, I believe, coming to us via the magic of telephone. Which is just amazing in the 21st century that we're using telephone. But c'est la vie. We do what we got to do here on the old VolView show. Starting off, usually he's coming from the hinterlands of Maine. These days, he's in sunny Florida. Probably happy he made that trade today. Mr. Rock Lobster Andrew Giovinazzi. Mr. G, what happened? Did the volatility VIX gods chase you out of Maine? You had to flee to Florida?
We're doing a vol presentation tomorrow. But I have to say the weather volatility actually is the only thing right now higher for me than the regular vol.
Yeah, it's pretty good these days. I don't know if Maine got blasted as bad as Chicago did, but Chicago certainly getting blasted. Also joining us today, he's not in his corner office down at the Cboe because he probably couldn't even make it in. Everything was shut down here in the city, including all the schools here. Mr. Kevin Davitt, senior instructor over there at the Options Institute at the CBOE, joining us from his home office these days, because we're better to be in a snow day than at home, but still doing the show here. Kevin, welcome back to the VolView show, to you as well.
Thank you for having me back, joining you from just north of the city in beautiful Evanston.
Yes, Evanston, beautiful. If you can take the L to it, it's not really a suburb, right? It's more of a adjacent township area, shall we say. All right, let's get to it with the team assembled. Let's dive right on into the volatility review.
It's time to break down the latest developments in the volatility trading world. It's time for the Volatility Review.
All right, everybody. Welcome to the Vol Review. And, not much to talk about this week, so let's just shut it down right now because it was kind of a boring week. Of course, I am joking. This probably was the craziest week in VIX history, at least for quite some time, just in terms of successive amount of volume we saw every day, successive amount of movement we saw in VIX Cash, of course, commensurate movement in the VIX futures, how that movement played out in such stark, dramatic fashion in the after hours on Monday and throughout the trading days the rest of the week. As we're recording this and streaming it live a little bit past noon central here, we're seeing a little bit of a sell-off again on the old street today. I say a little bit because in the frame of reference we have now, this is nothing. 1% in the S&P, pshaw. We laugh at that. That's just nothing. Of course, 1% pretty much across the board in most of the major indices. Indices kind of struggling to get their footing this week. A little bit of rally, a little bit of green. Nope, going to sell off again. All that red means, of course, VIX Cash on the green again into north of 35, into the 36.5 range. So let's just start off the show right there saying all of our crystal balls from last week, nowhere close. Because if you pick this week, then A, either you were crazy, or B, you're on your own private island right now. Either way, no one picked it. Let's just put it that way. So yes, very, very aggressive movements. But I think, guys, where we should start this week, because what everyone's got on their brain post-Monday, of course, is just this great, I guess you can call it the great inverse VIX ETP debate. Ever since Monday's movements and, of course, the Credit Suisse kind of after hours bidding up the futures and then pretty much shutting down XIV as a result and the other movements in SVXY, we've seen everyone and their mother awaken to these products. Even though we've been talking about them on this show for a long time, we've been warning people to read the prospectus and know what they're getting into for a long time, and probably advocating that people probably should take a more direct route with the futures or the options on the futures if they really know what they're doing, instead of using these kind of aggregated, quote-unquote, Frankenproducts, But c'est la vie. These things happen. This is in the prospectus. We saw it coming. But it seems like the world is kind of divided into two very stark, contrasting camps right now. On one hand, we have people on the regulatory side and others saying, this was a disaster. These products shouldn't exist. People like, Larry Frink over at BlackRock. Granted, he's got a dog in that fight. He doesn't have any of these products, and he has more plain vanilla type ETFs, and he doesn't like his ETFs being labeled and painted with the same brush as these kind of more funky, esoteric vol products, shall we say. So a lot of people are pushing for that, ex-regulators and others, so I wouldn't be surprised if we're going to see a lot of regulatory fallout. Some people saying these things never should have existed, they're monstrosities, etc., so on and so forth. In the other camp, we have people saying, these things, this is kind of what they were designed to do. They kind of clearly, well, maybe clearly in quotes, they put it in their prospectus, but it was buried 80 pages deep. But they did spell it out that they could shut these things down. At least XIV was spelled out. SVXY, it's a little more murky what the rules of engagement are there. But still, we saw this kind of spelled out. So this shouldn't come as a surprise to you if you know what you're doing. But clearly, the vast majority of the masses did not. So we've been kind of having this debate all week. It continues to unfold here on Volatility Views, and you guys haven't had a chance to weigh in. So maybe Kevin, we'll start with you before we even get into our activity for the rest of the week. Where do you fall on this? What do you think is going on? Do you think this was a case of too many people just trading a product they didn't understand? Do you think these products maybe were flawed or faulty or shouldn't have existed to begin with? Where do you fall on this great inverse VIX schism?
So from my standpoint, these products behaved as they were designed to, pretty much exactly as they were designed to. And I think there is absolutely, and you guys do a great job of pointing it out, but there is always a suitability question when you invest in anything. And typically people do not consider suitability until after they get hurt. We are humans, and we tend to make repetitive mistakes. And I mean, not to salt any wounds, because I understand a lot of money poured into these inverse funds. They have been incredibly effective for quite some time. But we didn't hear a whole lot of people complaining about XIV performance when it moved from 70 to 150 since August of last year, or from like 20 to 150 off of the Brexit lows. because it was doing what it was designed to do. Now, if you didn't understand, if you were invested in XIV and you didn't understand why it was moving at that magnitude, maybe there's a suitability issue, or maybe you were willfully ignorant. But either way, I think the onus is on the end user. And again, I'm not trying to be cavalier about that. I could go on and on about this stuff. I have an example of I've had a Merrill Edge account, and I am not in any way advocating for one brokerage over another. But that one was convenient because I have an account with Bank of America, and they're linked, and they didn't allow customers to trade options in vol or commodity-linked products. That's their decision, but education is key. We're humans. We tend to be drawn to greed, and now we're seeing the flip side of that. So, whether you think about, I don't know, everything should be treated with caveat emptor, whether it's, the expiration date on a carton of milk or the agreements we mindlessly kind of click yes to when we open social media accounts, or 40 Act funds. You need to understand what you're getting into. You need to know your risk, and what's happening this week is risk across the board is getting repriced.
Andrew, same question for you. And I know we talked about this with Mark yesterday. He actually wrote a lengthy piece for, I think it was The Street, kind of, I won't say defending these funds, but kind of saying what Kevin was laying out there. These funds actually did, or funds, products really, did what they said they were going to do. Maybe they didn't really put it dramatically up front in big red warning letters, which is actually what some of the regulators are saying now. These things should have massive splashed warning letters. What's the quote from the former CFTC commissioner there? These should have big warning letters. It should be written in big, bold, 24-point font and in red letters on the brokerage page. They certainly didn't do that. So is the fault maybe with the people, like caveat emptor? You trade these things, you should know what the heck you're doing, or is it more of a, perhaps, are you on the other camp that these products are monstrosities that must be driven from the world, sir?
Well, I think if you think about it like this, if you want to remember, let's say the 2000s, right, where there was eToys, there was WorldCom. What are some of the other names that we can drag out of the dust that were
Pets.com?
Yeah, Pets.com, and there was but so all that kind of stuff. Webvan, that was another one where, okay, I'm buying this company on the future, and the stock goes to zero, and everybody's grumpy about it, right? So, or WorldCom. The difference, I think, with these products is they're totally spelled out on how they operate. We are going to sell volatility futures that are extremely volatile, and if they double in price, the value of your dollars could go to near zero. They tell you that. So, and in part, obviously, Option Pit education, we educate people on that. I never like trading XIV without at least double the delta in calls against the position. So that way, if XIV does go out of business, your delta was covered at the time. So basically what I did was a delta management strategy on XIV. So, and at the last time I looked at it, it was like 140 or something like that. It would take you so many VXX calls when it was trading 22 to balance an XIV blow up. You would have needed like 5 calls. Now, that position actually would have made you money against 100 shares of XIV because your XIV was zero, but your VXX options were all worth about $25 a piece. So that is the only way I really like to trading that kind of on the bounce. So if you use these products, you have to understand how they work. And it's another thing like with SVXY, there were options listed on those. And to me, I always like trading the call spreads because the relative moves in vol were so huge when it moves, a call spread could pay. And either they pay or they go to zero. But you know that going in. So I think what would be sad is if every product that could lose money got delisted, then we would all have a problem because, even the BlackRock guys, what are you guys going to sell? When the S&P 500 was down 35% in the meltdown, should we delist every ETF because they had to go out and blast all their equities out because of, redemptions and stuff like this? So this is definitely one case, although the biggest problem I think with these funds is just a lot of timing. I mean, I saw some reports of SVXY. They got a $500 million investment, I think, on Friday. I'm still trying to confirm all of these things. But if they got a huge addition of capital, they go put all that to work, and then they have to go buy all the futures back the next day. I mean, that's a huge chunk of liquidity. So while I can understand why a lot of these funds cause their own problems, because they have internal short gamma, essentially. And that's another reason why UVXY is kind of all over the place, because these products have a heart. Act funny is the products act strange in a very volatile market. They do tend to do very well in kind of a slow trending market, but they have a harder time sort of pricing in a real volatile market. So the short answer is yes. With anything, obviously that's why we have an option education firm. By and large, our clients did pretty well. That just decided to kind of roll with, what's happening with volatility and everything else, because you have to understand the nature of whatever you trade. So I would say the short answer is, they are not. They went to zero on what I would call an extreme vol event. They helped create part of their own problem. And anybody should have to, anybody should understand what they're putting their money into. So I think that's where it is. But I am sure this was so ugly that there will be a congressional. Let's see. I'm going to do the delta. What's the delta on a congressional investigation into XIV? I'm going to say within a month.
Oh, it's super high. Yes, it's. People like you think Elizabeth Warren's going to let this one?
Whatever else they're investigating.
Yeah, you think Elizabeth Warren's going to let this one slip? This all of a sudden, inverse vol products are populist fodder. When is that ever going to happen again? You got to get while the getting's good.
Is, if those guys actually could balance the budget, then they wouldn't have to worry about interest rates. And I think a big part of the vol is that interest rates had gone from being kind of this, they're never going to move off the floor again, to all of a sudden, the bond market is repricing interest rates without the help of the Fed. And I think that's what's really unsettling stocks. And the bond market has always been the driver. If everybody worries about bonds, then that gets stock market prices jittery. So it's funny if Congress actually did what they're supposed to do and not spend so much money, or at least balance the budget or do something like that, rates would probably be more stable. But they're not. So I'm thinking as long as this continues, we could see a little more volatility until, the rates find whatever let's just call them their equilibrium area. And I don't know where that area is. And then once you see that, you'll probably see volatility stabilize and the market will be wherever it will be. It could be, it could be 2,400 SPX. It could be 2,300. I don't know. But it will be a new SPX with new shiny volatile interest rates, and and the VIX will probably trade 5 million contracts a day.
It's funny, these products, and by the way, that influx, and you're right, I've heard about that as well. That massive $500 million influx into SVXY on Friday might just be. That's up there with Soros piling into tech stocks in March of 2000. It's just one of the infamous poorly timed investments of our day. That's pretty. Someone just, hey, this short vol trade, worked out. I've been hearing about it all 2017. I kind of waited to pull the trigger. I'm going to pull the trigger now, a month into 2018. Well, guess what? That was literally the worst time you could have possibly done it. Our old friend the Whale did his rolling a little bit last week. We'll get to in a little bit how he may have done with this trader, may still be doing. It's kind of a question mark there. But before we get to that, maybe we can wrap this up with the kind of the camp I fall in. I don't like to take in between positions too much, but I think I tend to fall in between a little bit when it comes to this one, because we've been advocating for so long on this show particularly. People really should know what they're trading, and I understand. But I think that's also maybe a bridge too far for a lot of people to expect someone with a day job to really be extremely fluent and adept in all the nuances of these crazy inverse volatility products, and to be fluent enough to do what you should do with these products, which is always hedge aggressively, like Andrew was saying with VXX, or maybe with VIX products or SPX, XPY puts. There's a lot of different ways you can hedge these things, but a lot of people aren't even savvy enough to do that. And so maybe the barometer should be we've always said many times on this show, trade directly whenever possible. These Frankenproducts, that's what they are. They're aggregated together to replicate something else. So whenever you have that, it's going to be some sort of Frankenproduct. It's going to have all sorts of weird limitations and rules, as we saw play out this week. So if you want to trade the volatility of the VIX, there are ways to do it, and directly without any of these issues, which is, of course, the VIX futures and the options on the futures, if you want a more risk-mitigated way to do it. Obviously, just being naked short VIX futures has its challenges, is dangerous. You could have done pretty poorly this week as well, had lost even more, perhaps, because that doesn't cap you at zero, being naked short the VIX futures. So understand that, of course. But if you want the direct products, they're there. So I think I probably, and I have, advocated more for people. I know you say futures, people get spooked and terrified and they run for the hills. They don't want to do it. And there's a reason why these products have been so popular, because they're easy. It's kind of a set it and forget it. Well, they seem like they're easy, not so much in hindsight. And you can use them in a securities account, which was a big driver for a lot of people. But if you're going to be that interested in short vol, then you probably should take the extra step to actually educate yourself and learn what to do and learn how to trade these things directly. These people, quite frankly, a lot of them probably should not have been trading this product. And that's the shame, is that, some people got caught up in the moment, the heat of it. Maybe they read the articles in the journal and stuff. And every outlet had articles about the short vol feedback loop, call it what you will. How many people were trading short vol? The Target trader in the New York Times who made $1 billion shorting VIX. These articles were everywhere. By the way, speaking of articles, I just want to put it out there to the reporting establishment on this. Quoting Reddit and someone who lost money in Reddit or Twitter or anything else, that's not reporting. Go out there and talk to people. Actually do the legwork. Just reading off a forum and saying some guy said he lost $1 million on Reddit trading XIV. That's not your job. All right, do better. All right, but let's move on. So, any final words, Kevin, maybe on this before we move on to the actual week in review?
No, I would echo the belief that Andrew pointed to, that bonds have historically been smart money. We have seen rates move. I think that's the headline. And I don't know where this stops, but generally speaking, throughout history, there's examples of people chasing returns and eventually getting slapped, and this is going to be another one. And again, I'm not trying to be cavalier about the people that got hurt in this, but these are examples to take a moment to pause and say, all right, do I understand what I was invested in?
I think we can all get behind that. And with that, let's get on to this week's action, because it is an action-packed week. Of course, like I said, quite possibly I'd be interested to see other contenders for this that could hang with this week, but I'm going to put it out there as the craziest week just overall in terms of VIX history. Some of the biggest moves. We had a spike to about almost 46.5 back on Tuesday. We had a 30-handle range, started off the week at 16, spiked to 46, so a 30-handle range over the course of the week. We're hard-pressed to find another week where we had that sort of range, that sort of velocity of movement. We saw speaking of velocity, you saw VXX, excuse me. Oh, I'm sorry. You saw the velocity, the volatility, VVIX, volatility of VIX, spiking to over 200. These are levels I think we've only seen a couple of times before. So just historic, pretty much any way you can describe it. In fact, we're on mark yet again today for another aggressive day with VIX Options putting up today. Oh, already, it's only a little bit past noon, about 12:30 here Central, and already pushing close to 1 million contracts out there. So yet every day this week, well over 1 million contracts. I'm hard-pressed to think of another week that had that in there in terms of VIX Options. So it's just been, I think the technical term is bananas. Mr. Rock Lobster, obviously you're not at your computer right now slinging the ball, but what, a lot of things probably stand out for you. If you could distill out a few of them, what really stood out to you in this week's volatility maelstrom?
Okay. Well, one obviously is that the absolute move was pretty huge. But if anything, it was mirroring the move in SPX. You have 3% moves. You have I think the realized vol, 10-day realized vol in SPX shot to 60%. So VIX is going to go up. And it did. So VIX is doing its job. The strangest thing I think, actually it's not strange, but I think of note is the backwardation lag in the futures that have not bought into the higher VIX level. Every time we spike, I've seen like the Feb futures even early in the week as much as 10 points backward, expiring next week. that is usually as the liquidity provider and market participants are like, okay, we're volatile, but we don't expect us to be a 30 VIX market for very long. So that brings unique trading opportunities and pitfalls for people that trade VIX. So there was that huge backwardation. So the curve slung big, which I think generally is a pretty big opportunity. It makes a lot of interesting trades. That's why we're writing our vol newsletter to kind of explain stuff like that. But it did bring opportunity. It also made products like VXX, which everybody's used to just falling apart. The pull on those products is upward. So, every time we had a slight vol pullback in the futures, they would, VXX would crater for a short amount of time, but then the bid came right back. So just from that point of view, I think the future action, while it wants to not believe the volatility that VIX is delivering and the SPX is actually, creating because it's real, the ability to want to pull the plug on the futures has been pretty hard. That's why that backwardation, I think, has been so severe. And to be honest, I have to say, I don't know when it's going to go away. I don't know when. So the trade to me is, or if you're looking for a trade, is kind of like a more vol trade. We're going to have more of this level of volatility for a little bit until that rate picture, I think, gets more clear. So, and then you look at how the futures trade on that. So as long as those futures are staying severely backward, they're still not really buying the 30 VIX number. Even today, I mean, we had vol, but we were up and then we were down. So you're still getting intraday, 28, 30 vol intraday every day. And it's hard for VIX really to go down when we do that. And that's going to cause higher settlements for VIX and higher future prices as you go into settlement every week. So the weeklies take on, I think, a whole new significance because of how vol is trading. I mean, it is so volatile, and it's making. And I'm surprised. Actually, we've got pretty good liquidity. It has also been good for clients to see, when not to trade VIX at all. Wait till the liquidity kind of comes back and the market sort of normalize a little bit. You can look to put positions on and then wait till things go batshit again. Oh, sorry, bad crazy. But that to me has been the telling thing. The fact that just stocks are going down, that's not a huge surprise. I will be surprised on what really the trigger was. And I think it's the interest rate trigger, but the actual vol trigger mostly I think has just been the vol products themselves just trying to cover the squeeze. So those are the things I think that stood out this week. And basically I think it's still kind of you want to own some gamma in this market and just figure out how to do that. There's ways to do it, but the vol might be with us for a while.
I think that's probably the case. Look at Mr. Rock Lobster. He leaves Maine, and all of a sudden he's getting us on the explicit list here on iTunes. So, by the way, Mr. Rock Lobster, while Kevin's talking, see if you can go ahead on your phone and just find the Skype mute button there, because I don't want the money show bleeding through and overwhelming Mr. Kevin. Just make sure not to forget to unmute when it's time for you to talk again. That said, Mr. Kevin, you guys have probably been inundated over there at the CBO and the Options Institute with questions about what the heck's going on. And from a lot of your users and a lot of your classes, it probably has dominated the conversation. So again, I know it's a challenge to distill out a handful of things that really resonated with you. But see if you can. Let's try it with what really resonated for you this week from a volatility perspective, Kevin.
So messaging during times like this is important, and I think Andrew did as good a job as I could in many ways in pointing out that VIX is kind of like the temperature outside. And if you look at a mid-30s VIX right now, that implies on a daily basis about 55 handle moves in the S&P 500, and that seems appropriate. Now, the broader landscape with the term structure in the futures complex gives rise to a whole bunch of opportunity. And I think, like it or not, after events like this, we'll be the opportunity to educate because we're using real examples that are contemporary and being able to point out, look, it's been quite some time, but you have month one futures 7 points over month two. If you care to express this position over this time frame, that's how this might work in a direct futures play. This is how it might work if you want to do more of an options expression. And there's a whole lot of term structure opportunity in environments like this. I think the broad market move was probably a long time coming. I mean, I'm on here every other week or so now, and we've talked about it for quite some time. This is the longest stretch ever that the S&P has gone without a 5% pullback. It was broken this week. It was something like 404 days, so we're talking about like 2 years. But the velocity of this move is probably what concerns a lot of people that are more just passive investment types that turn on the TV at the end of the day after work on Monday or yesterday and see the cash Dow down 1,000 and the S&P's down 100 again. So like this is a 20-second 5+% pullback in the S&Ps since the March 2009 bottom. But on this one, so today we're incorporating today's cash move. We're a little bit beyond 10% on the S&P 500, and we've done that in 12 sessions. So the velocity of this, to Andrew's point on perhaps volatility is here to stay, and based on the volatility that we've seen in the underlying SPX market, it seems appropriate. So there's going to be a ton of opportunity in the coming weeks and months to show how events like this can play out. And when we start talking in a little bit about the whale trade, the roll, now that is a classic. That's going to go down as a classic example of how you use VIX options to maintain some exposure to an event like this to a T. And you know, it was a cheap way to give yourself this whoever has that on likely has it on against an equity portfolio, but they thank their lucky stars for a hedge during a week like this. And hedges have performed as advertised. And if you understand the utility of hedging here, if you didn't before, this week is case in point.
Yeah, our friend the whale, the misnamed VIX elephant. Some people out there, I think the macro risk advisors think they could go out there and give someone a nickname in the volatility space. Don't they know all volatility nicknames come through this show? We are the arbiters of vol nicknames here. So we call him the VIX whale. And it makes more sense than elephant. Elephant makes no sense. Everyone knows a big trader in a casino or a big player in a casino is a whale, not an elephant. So the macro risk advisors, they need to contact us next time they want to mislabel someone with VIX elephant. Just doesn't make sense. Doesn't even roll off the tongue. But that said, we'll get to him, the VIX whale, in a little bit. First, it's time. Mr. Rhodes is off in London. He's probably really mad that he's in London this week. He's missing the craziest week in VIX history. I know a guy who loves his historic moments in volatility, and he's only participating from them from across the pond. I'm sure he's quite sad. And he's also missing his weekly rundown, so Kevin's got to fill into the void for a little Russell's weekly rundown.
Now, Russell's Weekly Rundown.
All right, Kevin, you know the drill. Hold court for 30-odd minutes on all things weekly VIX options. Go, sir.
I promise you I'm not going to take 30-odd minutes, nor should we in a week like this where the macro story is the lead and we're not going to bury that. I'm going to focus on one spread that we saw go up early on in Monday using weekly options. So let me take you back to Monday. We had a fairly volatile last Friday. You had a cash VIX that moved back up to like 17 and change, which to put that in some context was the high tick from all of 2017. And we saw the Feb 27th, so effectively the end of this month, the Feb 27th, 20 calls versus the March 7th, 20 calls. So a 1 week calendar spread using VIX weekly options. That spread traded for 21 cents with March over. So it cost me 21 cents to buy time. That went up 8,000 times. Now, understanding what happens to plays like this if and when the VIX curve inverts like we saw this week or goes seriously backwardated, now that spread, so you had, this is early on Monday, your cash VIX somewhere around 17, futures below that still, we weren't inverted. The curve inverts in a big way, and this spread goes from 21 cents March over to 40 cents February over. But still, if you put the whole picture together and say, well, on Monday alone, cash VIX moved, or front month moved 115%, second month moved 70-something%, and a spread like this moves 61 cents, again, from 21 cents over to 40 cents under, that is someone that is sophisticated and likely understood the risk that they were taking. The buyer wanted to own that week. The seller was comfortable selling it for 21 cents. And something like that, to me, exhibits an understanding of your term structure risk and using the weekly options the way they're arguably designed to.
Well said, sir. You know, it's just a smorgasbord of activity across the board on the weeklies and on the big VIX options, like I mentioned, already pushing almost a million contracts today. In fact, by now it might even be crossed the million threshold. It's so active. And every day this week, it's just ridiculous volume. The ADV was up to nearly a million contracts a day. So that just should tell you it's been hovering around 660, 700 for the better part of the last year or so. And now all of a sudden it shoots up to almost a million contracts a day, 983,000 to be precise. That should tell you how much action's going up out here. And pretty much every day has been about 3 to 4 exit, if not more. Thursday, about 2.5 million contracts, about 2.5 million on Wednesday as well. Tuesday was, of course, the Crazy Town day, 4.2 million contracts roughly, and about 3.6 million going up on Monday. All this expansive move to the upside, we've been talking for a while about 4.1 VIX call to put. Of course, we blew through a lot of those strikes now, listeners. A lot of those calls are actually off the table now. So the call to put, a far more reasonable 2.8 to 1 out there. So Russell, wherever he is, Timbuktu, London, wherever, he can breathe a sigh of relief. I know he gets nervous around the north of 3.5 level. So nice massive explosion to the upside will do that for you in VIX options. In terms of the hot strikes, it's changed a little bit, I say, because the number one strike is still the same. It's the March 25s, 430,000 contracts. Number two, the Feb 22s, 405,000 contracts. Number three, the Feb 20s, 315. You'll notice some changes in this list, though, because who's not in there? Our old friend, the VIX whale, as he shall always be known. Because he closed out this week, or at least a good chunk of it. Number three, the Feb 20s, 315,000. Number four, the March 22s, 310,000. Number five, the April 22s, 261,000. Number six, the March 16s, about 240,000 contracts there. Number seven, the first and only put on the list, our old friend on the 12 strike, the March 12 puts, 227,000 there. Number eight, the March 15s with, about 205,000. Number nine, the Feb 19s with these are the weekly Feb 19s with 204,000, and round out the top 10 of the Feb 18s with 201,000. Total about 14.5 million contracts, or close to it, about 10.3 million on the calls, about 4.2 million on the puts. But of interest, we've been talking for a long time about our friend there who's been rolling that pretty much short 12 puts, long 15 call, and then double short 2x the 25 strike trade for some time. He started putting it on, I think it was back in July, and he's been rolling it ever since. He put on for the OC contract, though. And so he's been rolling, and Russell had a good kind of detailing of how he hadn't actually paid a lot to do that and kind of has been rolling pretty deftly. Our guest last week, or it was Don, I believe, kind of commenting how he rolled a little early this time. He rolled last Friday, and he was commenting, I think only half jokingly, that he did it because Super Bowl was coming up and he wanted to have some Super Bowl fun, so he didn't want to pay attention to managing his position the subsequent weeks. Kind of interesting timing that he did that because he rolled to March. So on Friday, what he did was he sold 432,000 of the March 25 calls, 62 cents. He bought 216,000 of the March 15 calls for $183, $1.83 there. And he sold the March 12 puts for 216,000 times still for 76 cents. So again, 2-to-1 on the calls versus the puts and the other calls. Then on Tuesday, after all the madness, because that's pretty much what he's been waiting for, listeners. He's waiting for this nice spike, at least on the option side of the trade. As Kevin alluded to, he probably has something else against it, which didn't fare as well this week. But the option side, he's been waiting for this move. That's what he's been doing. He's been managing his table stakes the whole time to get this big spike. Now, the one question I always have with this trade, and it was 10 handles wide, so I get why he did it, but I always was kind of questioning the ratio on the upside of this, because if we saw a crazy move, it could perhaps come back to bite him, and that's the question mark I have right now, because on Tuesday, he came in and pretty much closed it out. He did a little more, actually, so he must have had some others on in there, done some others extra. He bought 242,000 of the March 12 puts for 30 cents, so he made a nice 46 cents there. He bought also back 242,000 of the March 25 calls for $4.90. Ouch. So he lost $4.28 there. And he turned around and sold 241,000 of the March 15 calls. So he pretty much did it all 1-to-1 this time, which is also interesting, for $8.20. So he made $6.37 there. He did it all 1-to-1, which makes the math nice and easy. So he did it. He net profited about $2.55 on that trade. You do that 242,000 times. You see what Kevin was alluding to earlier. He pocketed a nice, let's say $62 million, somewhere in that range, plus or minus whatever his cost was for rolling. I think Russell had it on the last show a couple weeks ago. We'll have to factor that in. But the one thing you'll notice I didn't mention there is he didn't close out all of the 25s, and that was kind of my question. Now, even when I saw some other write-ups of this trade, I didn't see anyone talking about if he closed out all of the 25. Seems like, at least by our quick back of the napkin math here, and we haven't had a chance to sort through all the trades for every day this week, so he could have done some other stuff, but looks like he's still maybe net short about 190,000 of these March 25 calls, which at current prices, right around $4. It looks like he's out about 64 million on that other leg, which kind of makes him actually about flat. If we add up the 62 million he made and maybe the 64 million he's out right now, if he is indeed short all of that. Of course, there was a roll going up on Wednesday for about 50,000 of these March 25 30s. So maybe he did roll to the 30s for 64 cents. That's possible. It's only 50,000 though, so it's not enough. So it is possible. Like I said, we haven't had a chance to dig through every strike and every trade on these things all week. But it is interesting. Net looks like he did well, unless he is short that leg. I don't know, Kevin, have you been following this one? And what are your thoughts on our friend, how he fared well here?
I have been following this thing. To the best of my analysis, it does seem like whoever this person is left on a short March 25. Now, I think it's worth pointing out that the March futures are probably right around that now. The rolling calculation from what I look at is this thing went originally from a 20-cent debit to, at worst, early this year, $1.69. I'm sorry, put on for a 20-cent credit. After a couple of rolls, down $1.70, and now taking in about 305 is our net, like whatever the in-house math on that, with a naked short one March 25. Again, we could be totally wrong. We're speculating, but just based on the numbers, it doesn't seem like it was fully covered. I think you have March futures right around 25 right now, so perhaps they're comfortable with that. But I believe that part of this is uncovered, and if those calls go to zero or if something else is done against it, this person's hedge has worked out really well, and it is an example of using a structured play. Again, understanding the risk that you assume with a ratio call spread where you're net short units is important. But given the width of this, the outcome range was quite wide at expiration up to, assuming you put on a 15.25 call 1x2 for even, at expiration, your break even is going to be 35. So it's certainly possible. Look at Cash VIX now, but this person understood ratio spreading, understands the volatility complex, and a week like this is an example of why you continue to manage a hedge as opposed to trying to time when something like this happens, because you're not going to do it.
Yeah, I'm glad to see you guys thought he was kind of uncovered here as well, because that was the one thing that always didn't sit that well. I mean, he's doing this trade for a pop. Granted, he gave himself a nice 10 handles, plus, because he's got room to run then on the upside, doesn't just start losing money instantly at that 25 shot. He's got some profits to go. So he's got a good cushion. So I understand why he set it up. He was covered for a pretty aggressive pop. We saw a pretty aggressive pop on the show. So I'm glad to see you guys think he's uncovered too, which makes it kind of interesting. Maybe he's letting the dice fly on there and saying, yeah, I don't mind being short approximately 200,000 of the March 25s in this environment. I would be a little bit more concerned about that if I were him, but granted, this guy's been pretty savvy so far, so I'm not going to second guess him. But still, all this I saw people just glowing with how this guy's made so much money, and he did do a deft job up until this point, but it looks to me like he's still open. In which case, you can't close the book just yet on this being the most deft management of the whole thing. And I guess he didn't want to wipe out the whole thing for pretty much even, which probably would have cost him, or maybe lost a little bit net with all those 25s. See, you see the danger of being naked net short. Some upside in VIX, listeners. It gets pricey when you need to buy it back. That's the one downside for this. Before we move on to some of the questions, actually, we're kind of getting late, so maybe we'll go to the question. We'll save the VXX conversation for another week. But suffice it to say, all you people out there who love your VXX erosion play, you got another swing at the bat this week, because it pretty much reset the VXX clock all the way back to post-reverse split days and then some. It actually went past it into the 50s, I believe, out there in VXX land. So all you who are lamenting, maybe you mixed the VXX erosion trade, the clock has been reset. So far, we're still in the froth right now. Once that froth settles out, though, maybe it'd be interesting times to do just that. Let's keep on rolling, though, into some of your questions. It's time for the volatility voicemail.
It's time to share your thoughts and opinions with your fellow volatility traders. It's time to check the volatility voicemail. Make your voice heard by dialing 779-669-4VOL. Posting a comment on the optionsinsider.com, sending an email to questions@theoptionsinsider.com, or posting your questions to twitter.com/options or facebook.com/theoptionsinsider.
All right, everybody, welcome to the old Vol voicemail, the portion of the show where you guys take the reins, questions, comments. Also, Kevin, we get to ask them, turn the tables on them a little bit, which is kind of fun. In fact, we asked them a fun flash poll yesterday. I'd be curious to get your thoughts. We also have I'll ask you both, our VIX prognostication poll as well. But we asked them yesterday. This one's wrapping up pretty soon, so if you haven't voted yet, listeners, get out there and do it. It was kind of a quick little flash poll out there. But we thought, hey, all this talk about XIV kind of heading to the graveyard, but SVXY still trading. What do you think about that? Do you still have confidence in that product? Very simple question. Do you think SVXY will still be trading at the end of the year? Yes or no? Or are you hiding under the bed? So you got to answer that one first, Kevin, and then I'm going to toss you the second one, which is we asked everybody. Well, I'll ask you to pick what the audience picked on this one, because I don't want to have you give away your question, your pick yet. But we asked everybody, hey, VIX is crazy town. We asked them to play the crystal ball with us this week. Where do they think the VIX is going to be? Is going to be on the close on Friday, so not showtime. Crazy town 30 to 35, ZombieApocalypse level, which is north of 35, aka where we are right now. 25 to 30, which is just crazy, or mildly crazy, shy of 25. So you got two questions to answer, Kevin. Both times you have to put on your listener hat, because you have to kind of guess what they're guessing.
Okay. I'm a little bit reluctant on both, just because of the environment we're in. But on the SVXY question, my guess would be that, yes, this is still trading at the end of this year, and I would prefer to just leave it at that. And so we're talking about the cash VIX settlement today, correct?
Yes.
All right. Now, in our range of outcomes, we are firmly in zombie apocalypse land right now?
We pretty much are, yes. We are north of 35. Actually, we're pushing 41 as we're wrapping up the show here.
Okay, so, wow. Do I think we're going to close below 35 on cash VIX today? My assumption is no. If I had to look out a week from now, and maybe we're still going to do that, I would imagine that we move more into the crazy range, somewhere between 25 and 30. So I think we're gonna close today in zombie apocalypse land, just like the snowpocalypse outside in Chicago. And I think at some point, maybe next week, we come back just to your standard crazy.
Yeah, our audience is all across the board. They actually were picking mildly crazy, which is south of 25 for today's close. I don't think we're going to get there, listeners. So, and Zombie Apocalypse number 2 with north of 35. So we'll see. We got a little bit of time left for that one. And in terms of, it's actually interesting in terms of SVXY, our audience is evenly split. 42% for yes, 42% for no, 16% say you're hiding under your bed. So exactly evenly split, kind of like what we're seeing in the marketplace right now. Go figure. Interesting stuff. Let's see. We got a couple. You got a bunch of your questions. Let's see if we can answer some here really quickly. Chris T wants to know the most I can lose buying SVXY is the price I pay. Correct. So if I buy it around 10 and treat it like a lot, can I buy it around 10 and treat it like a lotto ticket call? Yeah. First off, any money you put in these inverse vol products these days, it should be money. You're at least, it should be speculative money, shall we say. It's not going to be your retirement fund because we've seen what can happen with these things. You have this issuer / counterparty risk to factor in, which is, as you've seen this week, can be sizable. And the SVXY kind of liquidation termination rules are, I think, a little bit murkier than XIV had it clearly spelled out 80%. And I've yet to see an exact percentage for SVXY when that acceleration / liquidation event can occur. But yes, you're pretty much right. I don't know, Kevin, anything you want to add on? Can he go -0, below 0 and owning SVXY?
No, I mean, if you have a margin account, no. In short, somebody like that, you should be dealing with risk capital and understand the risk. But no, if you buy it at 11, 100 times and you're fully margined, that's the most you can lose.
We got here a comment from actually a prediction from Scott Somer. He says, I think this actually came in last night, so it's actually not that far off. He said cash VIX will be 37 during volatility views. So he's close. It's about 40 and a half or so. So not bad for early prognostication. Now you see how hard it is for us every week, Scott. Would be curious how much a Feb 14th 40-50 call spread would go for. Interesting. I'm not going to have time to pull that up for you right now. Let's see really quickly here. Lamina wants to know. Scott also had a comment here. Another day, very large sell-off heading into the start of the option block and an up move in the S&P futures during the trading block. Yeah, he's right. That was from our show yesterday. We have been kind of spooking the market with our option block show of late, it seems like. So the things. Let's see, the ETF, inverse ETF ones, we got a lot of those. Let's go right here to this. We already touched on that a little bit. Andrew actually touched on his preferred way to do it at the top of the show, which was to have more deltas of the VXX calls in your back pocket if you are going to have a position in XIV, because of course you knew XIV and VXX, two sides of the same coin. You're not going to have a position in XIV anymore, at least hopefully. So you have to adjust accordingly with SVXY and others. You know, there's VIX calls, VIX call spreads, probably a better way to go. SPY puts, a lot of ways you can do that. But Lamina wants to know, question here about the futures, Kevin. Says, VIX Cash is trading above the futures right now. How is that possible? Isn't the cash value derived from the futures? There's a lot to unpack here, Kevin. A lot that's kind of a misperception, shall we say, about this statement, where the cash VIX comes from, how it relates to the futures. I don't know, Kevin, do you want to correct some of these misconceptions here from our listener, Lamina? How can the cash be above the futures, Kevin?
I'm not here to correct anybody, but spelling out and educating people on what cash VIX tells us and what the futures tell us and what can be implied from term structure is more hopefully what I'm able to do from day to day. So cash VIX, absolutely, as evidenced by this week, and maybe more often historically than a lot of people are used to because of recent memory. On average, the cash VIX or month 1, month 2 of the future spread inverts, where you see the cash at a premium to month 1 and month 1 at a premium to cash 2, or a downward sloping term structure. around somewhere between 15 and 20% of the time, historically, okay? It has been significantly less than that if you just factor in the past couple of years. Inversions have been very, very brief. So what we're in the middle of, this inversion currently, is unusual if your time frame is 2 years long. If it's 2 decades long, that's not the case. So what does VIX tell us? It is a constantly updating 30-day anticipated volatility number based on SPX options. It is not an investable tool. So it's essentially the temperature, and that can absolutely, and Andrew's laid out, and hopefully I elaborated a little bit on why that current cash VIX level seems appropriate. That implies S&P moves on a daily basis of about 55 points right now, and I'm staring at, we've had a range of absolutely greater than that today and most days this week. Now, futures are an anticipated volatility level at some point in the future, okay? Futures cash settle and roll into or roll toward the cash market. So typically it's a roll down. When you're in a contango market, it's a roll down where futures move lower toward cash. The opposite is true in an environment like this. And the one thing that I would like to point out, because I could talk about this for another hour and a half, but we don't have the time, is that the entire term structure got bid up this week. So if you look at 8 month out, 7-8 month out futures, the entire term structure got bid up. So you have like September futures that have been well above 18 for most of this week. That is the marketplace telling you that as of right now, the anticipation is that volatility is here to stay. You may or may not agree with that, but there are ways to play the term structure directly using futures or ancillary way using options if you understand how that relationship plays out. So it's a really, really good question. Cash can absolutely be over or under your futures, but understanding what that term structure, whether it's inverted, seriously inverted like we see right now, or a typical contango, what that means, what it says about the broad market is the homework that you need to be doing if you are accessing tools that are volatility linked.
Spoken like an instructor at the Options Institute. Well done, sir. Unfortunately, we're already over time, listeners. There's so much stuff to get to this week that it's can't even get to this. This is the first time we haven't even gotten to a crystal ball. I feel bad, but on the other hand, I don't have to pick this week, so maybe not the worst thing in the world. Given all the craziness, I'll give everybody a pass this week because it is, shall we say, nut job land out there this week. That music, of course, means we're done. If you're listening live, stay tuned. We'll be back in a little bit, about 25 minutes or so for TWIFO. So if you can't get enough of index volatility and skew and all that good stuff, guess what? We're going to get into it a lot more on that show. We got you covered, plus a lot of crude volatility and action and skew and all kinds of fun stuff. So stay tuned for that. But before we go, let me go back on the horn. Check with my cohorts here. Our boys at the Pit had to go. They're down at the Money Show. So check them out, optionpit.com. Maybe at the Money Show right now, in which case you can go say hi to them in person. They even got Andrew down there. How weird is that? He never leaves Maine, and he got him down to sunny Florida, so that's a big thing. So if you want to see Mr. Rock Lobster in person right now in Orlando, is the place to do it. Otherwise, head on over to optionpit.com. And Mr. Kevin, I'm guessing you guys have put together all sorts of cool stuff to educate people on the world of volatility. Maybe you're bringing back some old stuff this week as well, because everything old is new again. What's cooking in the land of the Institute and the SIBO blog, sir?
You're right that everything old is new, and there's kind of nothing better from an education standpoint as current examples and what that means. So we will refresh and we will continue to point out. I mean, I have the benefit in that I have nothing, literally nothing for sale, and I get to advocate for an industry that I love and products that hopefully I understand and can articulate well. So we'll continue to do that. Send us your questions. Hopefully we can help you. And always, always, always understand what you're invested in. Know your risk. Think about worst case scenarios, and then decide if that's something that you're comfortable assuming.
There you go. Check it out. You know where to find them. CBOE.com. You can see what Kevin puts on the blog there. You can put what Russell and all the rest of the team puts on the blog there. Read all the quotes. Get the Bitcoin futures quotes while you're there. I know that's pretty popular. And, of course, hey, maybe if you're around here, maybe not, you can take one of their virtual classes. A lot of good classes in the offing over there at the CBOE Options Institute. Check it out. And on behalf of Kevin and Russell and the Rock Lobster and the Meatball, who was somewhere in the background there today, and indeed myself, I want to thank all of you out there in the listening audience for downloading and streaming and subscribing and for surviving a very tumultuous volatility week. Pat on the back. If you did indeed have some black marks there from the inverse volley TPs, our outs go out to you. Hopefully next week will be better for you. You start making it back there. And we'll see you next week. Or, of course, if you're listening live, we'll see you in a little bit for Twifo.
Volatility Views is brought to you by Cboe. Cboe is one of the world's largest exchange holding companies, and we're inspired every day to innovate some of the industry's most powerful products, technology, and solutions. We're the industry's leading force driving access to global markets. A better trading experience and powerful data and analytics to inform better strategies. We're committed to engineering new ways to help our customers realize their potential and navigate the marketplace of tomorrow, today. Visit Cboe.com. That's CBOE.com to learn more about our expanded offerings.
The preceding program was a production of the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/The Options Insider, or via questions at theoptionsinsider.com.